A great place to start when looking for undervalued stocks is to look for negative stock price performance. And in this video, that's exactly what we're going to be doing. All three stocks this year have been absolutely decimated, and I think they could be some prime pickups for the month of April. Now, in case you're new to the channel, my name is Sam and I've been investing in the stock market for over 5 years now. And on this channel, we strictly talk about undervalued stocks only. So let's not waste any more time and get into my first stock, which is Alibaba. Alibaba is down 70% on the year and it's back below its IPO share price of $100 a share. This Chinese giant has been absolutely decimated, but let's take a further look and see what's behind this company. Now, what do Alibaba do? Well, Alibaba is the market leader in e-commerce in China and one of the largest e-commerce companies in the world. It operates a range of e-commerce platforms, including Alibaba.com, Taobao, and Tmall, which all have millions of active users that generate billions in revenue for the company. Furthering on from that point, Alibaba has a huge amount of diversified portfolio of businesses that include e-commerce, cloud computing, digital media, and entertainment. This diversification allows a company to mitigate risks and capitalize on new opportunities in different industries, making this company one of the largest and diversified businesses in the world. Now, I think what makes Alibaba really interesting is the innovative technology that they're going after. Alibaba is at the forefront of technological innovation. The company has invested heavily in artificial intelligence, machine learning, and big data to help improve its service and enhance the user's experience. Now, swiftly moving on, let's take a look into Alibaba's financials. Let's take a look at their income statement, balance sheet, and cash flow statement, and whether or not we're getting great value in this company. Now, in taking a look into the juicy financials of Alibaba, we can see that their revenue growth has been massive. They've gone from 39 billion in 2018 to the last 12 months doing 125 billion. So that means that the year-over-year revenue growth has been massive, averaging a 30% compounded rate year over year. Now, looking further down, we can see their gross profit has gone from 22 billion in 2018 to now the last 12 months going from 45 billion. We can see there's been a steady decline in the gross margin, but I imagine that's been impacted by inflationary pressures, which hopefully should ease and hopefully their margin should get back to that 40-45 range that they've recently been doing. Now, noting one thing is the net income statement. This has varied heavily from going from 10 billion in 2018 to 23 billion in 2021, and now we're back down at 4.7 billion. And the reason for this is when we take a look at the unusual items, we can see that they've lost a 5.4 billion sale of an investment, and this has led to a 4.7 billion. However, if we remove this, we're looking back at $11 billion valuation in terms of net income, and that has probably led to the stock price performance of Alibaba underperforming over the last year. Now, taking a look at Alibaba's balance sheet, we can scroll through this very quickly because one thing is clear, it's very impressive. They have huge cash and cash equivalents of over 75 billion. And this puts them in a fantastic position because due to their debt levels, they have very little debt. And when we take a look at their total assets to total liabilities, we can see they have 256 billion compared to only 97 billion, which means this company has far more assets than liabilities, and the chances of them going under is extremely unlikely. Now, the other thing is looking at their long-term debt. They have 21 billion in long-term debt, and with cash and cash equivalents at 75 billion, this puts them at almost 3 to 4 levered cash position. Now, what are we paying for Alibaba stock? Well, we can take a look at their metrics and we can see that an enterprise value to EBITDA ratio of 8.6 is far too low for a company that is growing over 30% compounded. Now, that also includes the PE ratio at a 12 and also a free cash flow ratio at 12, meaning that the growth rate of this company is far outweighing metrics that they're currently at, meaning this company could be a great buy for future potential of our stock price. So we can clearly see that Alibaba, on a valuation perspective, is a cheap company. We can see the metrics all over determine that historically this is a great time to buy. But is there more risk than there has been in the past? Well, that is the question. And with the Chinese government and regulation concerning profits in the future, we could see that stock performance may not impact over the future as well it has in the past. So this is where you have to make your own decision whether you're buying or not. There are huge geopolitical risks in this company, and the American investor may not want to look to a Chinese company for a long term. However, there have been some good news articles come out of China and Alibaba, and one of them is the restructuring of Alibaba into 6 different businesses. And if these 6 different businesses are valued at a closer and more tightly monitored valuation, we could potentially see greater upside in the month of April for Alibaba. Now, whether or not this actually translates is speculation on my part. However, it's certainly one thing to consider going into the future. And with certain IPO ratings of these different companies, I think there could be some huge potential for the month of April for Alibaba. So if you guys are familiar with this channel, you will know that one of my favorite stocks is Overstock.com. And this is a stock I'm going to be talking about as my second stock today, because I can't leave this stock out. This company has something within which makes this company extremely interesting and extremely undervalued. And I think this stock could be 5 to 10x potential. So let's get into it. This online furniture retailer store has much more behind closed doors than just sofas and beds. It has the best digital exchange, which is regulated in the world, with one of the best operators in the market, with David Goon. And that company is T0. But first, let's talk about the retail business, because there's been some recent developments that I think makes this company extremely interesting, especially when we consider this is at an $800 million market cap, and they have over 370 million in cash. So as mentioned, this company is trading at under $1 billion market cap, and we are essentially buying this company for 650 million when we consider the net cash position. And this company is producing 27 million in operating income, which is impressive given the tough backdrop and economic environment that we're currently operating in. When we consider interest rates are at the highest they've been in decades, this company continues to outperform, which I believe makes the retail business valuable. But now let's talk about Overstock's positioning within the retail market. Bed Bath & Beyond is one straw away from the camel's back breaking, which makes the company extremely interesting when we're talking about market share gains. They are highly unlikely to receive any funding due to the amount of debt that's on Bed Bath & Beyond's balance sheet. And this means that bankruptcy is imminent, in my personal opinion. With Bed Bath & Beyond's imminent bankruptcy, this leaves up to $8 billion up for grabs for Overstock to take. And Overstock currently does close to $2 billion in revenue. And if they take 10%, that could potentially lead to a 50% increase in Overstock's revenue. And that will eventually translate into the bottom line, making this company much more profitable and much more valuable. And I think from a pricing power point of view, with less competition, we could also see Overstock's margins increase over time. And as Overstock is currently focused on the home value space, I think this is exactly the perfect space to be in. But it gets even better from an Overstock perspective, because the number 2 player is in a very similar position to Bed Bath & Beyond. Wayfair currently does over $12 to $13 billion in revenue, and this company has $3 billion in net debt. With only $1 billion in cash, that means this company can't service the net debt. And this is what makes this company so interesting, because once this company has to restructure, we could see this company being much smaller and Overstock being able to double to triple their revenue depending on how much market share they can take from Wayfair and Bed Bath & Beyond. Now, this is just the retail business, and the best part I haven't even spoken about yet, and that's T0. And I think this is going to be worth billion of dollars. So let me explain a bit further breakdown of what T0 actually does and why there's so much value in this company already. T0 is a subsidiary of Overstock.com that was launched in 2015 to develop and commercialize blockchain-based financial technology. T0 aims to create a more efficient and transparent financial system by leveraging blockchain technology to eliminate middlemen and streamline financial transactions. And one of T0's main products is a blockchain-based securities trading platform that enables the trading of tokenized assets. So remember that, tokenization. The platform uses smart contracts to automate the settlement process and eliminate the need for brokers, custodians, and clearing houses. T0 has also developed a number of other blockchain-based products and services, including a digital wallet for storing and managing cryptocurrencies, and a platform for issuing and trading security tokens. With the introduction of David Goon from ICE Markets is a $50 to $60 billion business, and he was number 3 on the board as a CSO. So why this is so important is because ICE Markets is the parent company of the New York Stock Exchange, and T0 will be able to synergize all of that through the David Goon and ICE partnership, making this so significant for us as shareholders, as Overstock shareholders, and T0 shareholders as well. And this is why I think this business could potentially be worth billions. Furthering on from that, when we hear about all the news about Coinbase and all the regulatory issues that have been playing out as of recently, the only SEC and FINRA approved exchange is likely going to be T0, and the others are either going to have to comply or they'll have to be going out of business. And this is where the SEC is clamping down hard, and T0 is the answer. Now, something which I think could be really interesting is T0 could potentially offer a white label service to Coinbase, and they could do this through their tokenization platform, essentially tokenizing all the assets and allow Coinbase to become fully compliant within T0's system. And this would then allow another revenue source for T0, making their company even more valuable. As an Overstock shareholder, it is worth noting we own 55% of T0. So even if it was valued at a $2 billion or $3 billion valuation, we would only get $1 billion worth of the actual equity itself. However, when we consider Overstock is trading at only an $800 million market cap with almost $400 million in cash, the risk to reward in this company could be massive. And I think if T0 ends up scaling up, we could see this overtaking companies such as Coinbase, which is currently valued at $11 billion. So I'm thinking, as a regulated SEC and FINRA approved exchange, how valuable is T0? Now, in summary of Overstock, we have an extremely cheap retail business where the competition is going out of business, which means we could gain huge market share, accelerating the revenue and increasing the bottom line. And this is really interesting because at a valuation at 800 million with 400 million in cash, we'll be able to use that cash with great optionality to expand the business and grow market share. And I think this puts Overstock in a fantastic position in terms of the retail business. And then we consider Medici Ventures. We own T0 55%, and this digital regulated exchange, their competition is going out of business, and T0 is going to be there to pick up all the pieces. As the SEC clamps down, this is going to give T0 a great option to grow and expand their client base. And we haven't even considered the other 18 businesses with inside Medici Ventures. But if you want to catch that, you can watch my other Overstock videos where I go into more depth and detail discussing other companies such as Bit Global and GrainChain, which are also potential big winners in Overstock. Now let's get into my third stock, Olaplex. Olaplex is a great business for several reasons. Olaplex offer unique products that help to repair and strengthen hair during and after chemical treatments, and their patented formula is the only one of a kind that has gained a loyal following among both professionals and consumers. And also, Olaplex has built this strong reputation for delivering results and has garnered positive reviews from customers and industry professionals alike. And this has helped establish the brand as a leader in the hair care industry. To add, scalability has been huge in this company, and they have a wide range of products, including shampoo, conditioner, and styling products, which can be used on a regular basis, making it scalable business model. Additionally, the brand has also expanded its products offering recently beyond hair care, and now they're including skincare and other body care products. Through using celebrities such as Kim Kardashian, Jennifer Lopez, and Drew Barrymore, Olaplex has been able to expand their brand awareness and drive their sales massively. And this growth company has expanded huge, but we can get into the numbers a little bit more. Now let's get into the numbers of Olaplex, because in an extremely difficult and competitive environment in the beauty market, this company has been right up there with huge high growth revenue and also fantastic margins that are going to blow your mind. So let's get into it. Let's get straight to it. And we can see that this company is producing close to 300 million in free cash flow. And that puts this company at a 12 PE and a 13 free cash flow. With a growth rate at 15% for 2024 on future numbers, this puts the company business close to a 10 to 11 PE. And this is far too low with a company that is doing 80% gross profit margins. And the revenue growth has been huge, as I can see, and also operating margins at 55% warrants a higher multiple than a 10 to 11 PE. To add, the beauty industry is also a huge total addressable market, and Olaplex is nicely established, and the loyalty it has within its brand will make it a great final addition to your portfolio. Now, to summarize Olaplex, this company is again far too cheap. At $4 a share, we get a lot for this company, and at a 10 to 12 PE, I think there's some real value in this company today. So I think if we're looking for a quick turnaround, I think this could potentially be an easy 2x stock. It's already gone from $4 to $6 very quickly before, and I think we could then see this again. And I'm hoping that in the future, I'm expecting this company to trade at more like a $12 to $20 range, depending on execution and future growth rates. But I'm expecting this company to be fantastic in the future, and with their high margins, it makes it one that you need in your portfolio. If you guys enjoyed this video, make sure to drop a like, subscribe if you haven't already, and leave a comment letting me know your thoughts about the 3 stocks in the month of April. I've also recently just opened a Patreon account, so you're more than welcome to support me on there. But in the meantime, I'll see you guys in the next one. Thanks for watching, guys.